Simon Brown here with our Friday Fund Friday. Today we're going to be looking at ETFs for retirement. We've had a bunch coming through, bunch of requests, particularly looking for retirement orientated ETFs. So I thought, great idea. Let's look at some of those. I'm going to look at them individually. Obviously, you could structure a portfolio more broadly around them, but I thought let's get a sense of what's available. And I looked at two things. So volatility, which is sort of, how much do they crash or rush or whatever. In essence, a low volatility is a smoother type of style of investing. So there's four in that space. There's the MAPPSP from ABSA, global dividend aristocrats from Core Shares, the low volatility also from ABSA, and then volatility managed defensive equity also from ABSA. We'll delve into all of them. I've got the sheets here. We can talk around them. And then focusing on yield, two areas really. The preference share ETF, touched on it before. I'm going to go back to it. And then the bond ETFs. I'm not going to delve into the bond ETFs. We've got a video on YouTube. You can find those on the YouTube channel. Search Standard Online Share Trading. So I'm not going to delve into bonds in this one because we've got that content there already. But also just to say quickly on the yield, ETFs such as the Dividend Aristocrats, there's a local and a global from Core. Their methodology is to use dividends as a quality metric, and the focus is not size of dividend. So you don't necessarily get a big dividend. Ditto with the one from Satrix, the Divi Plus. Again, they use dividends as a quality metric, so you're not necessarily going to get a high yield from them. So I've parked both of those aside. The Dividend Aristocrat certainly comes in as less volatile, but rather than a yield. And we've got, and let's kick off right on the side over there, and let's make that a little bit wider so that it all fits. So we've got the New Funds Low Volatility ETF. This is a 31 March minimum disclosure document. I couldn't find a more recent one. I would have expected an April at least, maybe even a May, but it's what we've got. Coming out of the ABSA stable. And key point is, what is it trying to do? So it's looking for low volatility ETFs, and it's aimed at the theory being that a low volatility could over time give you better performance, and in theory be a better investment. Now, the chart down there is not of much use because it's showing it relative to its index. Now, let's go have a look at in particular, and what you can see is that certainly when markets crashed earlier this year, so did this ETF. And that's a key point, is that back in March, when markets were crashing, late Feb, March, they bottomed, around 23, 24 March, is that ultimately everything went down. I mean, what you're looking at in an ideal portfolio is you want diversity, you want different asset classes, geographies, different sectors, currencies, so that you don't have everything correlated to one. What I mean by correlated is that, everything sort of moves in lockstep. And that works until we see a global collapse in stock markets, in which case everything becomes correlated to one and everything goes down. And back in February and March, all equities went down. Bonds took a pounding, not helped locally by us also moving into junk, but nonetheless, globally they took a pounding. We saw gold off, commodities under pressure, Bitcoin. Ultimately, and the reason is quite simple. People are panicking. They're worrying about paying bills and they need cash. And where do they get cash? Well, they sell things. Now, what they'll often do is sell what has fallen the least, but then that starts to fall too. And then, of course, a lot of hedge funds and traders, etc., start getting margin calls because they're getting squeezed because they're on the wrong side of the trade. They also need cash and they start selling. So, can you, what didn't go down? What didn't collapse in February and March? Short answer, cash. Just good old-fashioned cash. And that then thinks I should have actually included the Tracy in here. And let me go quickly pull up the Tracy. The Tracy is literally just a cash account, NFTR. It's not actually called the Tracy. I call it the Tracy. The Tracy is literally just a cash. And if I just pull that up, now I want that one there. Basically, what you've got here is a money market ETF. It basically, and look at that for a perfectly straight line. The trick with it is that the rate it's offering, so I Not sure what it is now. It's about 5%, 5.5%. In a low interest rate environment, that's nice, but not necessarily great. And then we go back to, and I've talked about this many times before, where we're looking at the, and it's not going to come up, is it? Retail government bonds, which are currently locking you in at 5 years for 8.5%. There's the link I'm looking for there. So if you're looking for cash and you're happy to park that cash away and you're looking for a return, at the moment, government retail bonds are offering you the best rate out there, 8.5%. That is locked in for 5 years. Or your inflation-linked bonds. So what they do, and this is quite a chunky offering here, the inflation-linked 10 years, the capital will increase by the CPI, whatever that might be. And then on top of that, you get in this case, a 5% yield for the 10-year, a 4.5% yield. Now, at the moment, inflation is, you didn't get April inflation, it got delayed by a month because Stats SA couldn't get the data due to the lockdown. But inflation is probably 3.5%, but it protects you against inflation starting to rise. So in that regard, hugely important. So the low vol one, and let's go down and have a look-see the asset allocation and the particular stocks into it. So it's got mostly financials, then consumer goods, and by mostly financials, 45.9%. And note that Fortress REIT, it's a property stock, but it is considered a financial. Rainnet falls into financial as well. British American Tobacco, the big holder, Richmond, ABN Bev, BHP, AVR, Vodacom Spa, and GrowthPoint are your big weightings in that particular one. So it's going to be equities, but it's looking for lower volatile. Now, obviously, the volatility spiked pretty much across everything when we saw the collapse in Feb and April. I got to say, if I was looking for defensive, I'm not convinced that a low volatility ETF would be necessarily where I would be jumping in straight away. The MAPPS Protect is an interesting one, also for MAPPS. So MAPPS is, in essence, a balanced fund, but an ETF balanced fund. And let's go have a look at what it's holding. The asset allocation, what you can see is fixed income is 52%, equity at 4%, and cash at 13%. Now that doesn't tie up with their portfolio holding, and I forgot to check the date of this one. Also 31 March. So I haven't updated their dates. Those two numbers don't tie up because Naspers is their big holding at 13%. Equity at 41%. Cash was at 6.9%. But what you see here is actually a large amount of fixed income, which is your government bonds, and you can see them all sitting there, your R197202, the R212210, 210, et cetera, and then some inflation-linked ones at the same time, expiring 2025 and 2050. So what this will do is if we look at what happened in the recent sell-off, it came down, but let's head quickly to here and to Viewpoint. MAPPS Protect. So there are two maps. There's a Protect and a Growth. They're both mixed. You can certainly see, and let's take that to a weekly view. It certainly did, it took a fair bit of pounding, but it went from 39 to 31. In other words, I mean, what's that? Let's call that 20%, when our market was a lot more than 20% down. So it actually didn't do half as bad as a normal equity. It was a lot less volatile. Now, what we had here was a weird scenario where the crash and the recovery was, really double quick time. But what we see is because of that cash holding, because of the large weighting to bonds and what they call fixed income products, they came under pressure, but they came under a lot less pressure than equity did. So it kind of, to a fair degree, did what it said it should do in the sticker. I mean, it did fall. It was down some 20-odd% from the highs of Feb to the lows of March, but it held on a lot better than a sort of normal general equity, and then certainly what we did see in the space with the first one, the low volatility. And then another one from ABSA, which is quite an interesting one, Volatility Managed Defensive Equity ETF, also only at 31 March. How this one works, and it's complicated, but I'm going to give you the simple version of it. is that this ETF holds a blend of cash and equities. And as volatility starts to rise, it increases the amount of cash. So that in a perfect world, as that volatility and markets are falling and volatility is spiking, it pivots into cash. And then on the inverse, as soon as things start to go the other route and start to recover, it then moves out again. And you can see the equity allocation. It's never more than 60%. And when things were looking a little rough earlier, that equity allocation went to cash. So, and it protected you. It gave you that downside risk. And what we're sitting at the moment in terms of asset allocation, 100% cash. Now, what it's had in the past, it's had equity in it. It certainly has. And you can see the equity that sits there and what that equity would look like. But when the market was falling, it then moves into cash, and that protects you from some of that sell-off. And then as the market starts to recover, and what you notice, and this is to end of March, so it probably has subsequent started to pick up into more equity. So ABSA's got three of these. This is the very defensive, then there's a medium, and then there's a high risk one. But this one kind of, and the logic, the phrase they use is that you fall into the hole less because of that quick move into cash. And let's go have a look at it in terms of NFE, and now I'm not going to remember the whole code. I think it's NFEDF, DEF rather, defensive is what they call it. So, and let me drop to a daily so we get a much clearer view of what we're looking at. It's relatively new, and the thing with this is we weren't sure how it was going to respond to a market falling down. So if we go back to February, it was trading around the R9.50. It only fell down to 9.15. So it fell, let's call it 6 or 7%. From its highs of November, 9.85, it fell, let's call it 7 or 8%. Then it starts to recover, and then it moves into cash, and now it's sitting there, and it'll start picking up some equity in that particular space. This is I like the idea behind it. I like the methodology. It's never going to, when markets are storming ahead, it'll lag because it's sitting in a large amount of cash. But when markets are under pressure and they start collapsing, it moves into cash. Now, it catches some of that fall off. Of course it does. But even when the fall off started, it was still sitting in cash. If we look at the asset allocation, at that point, it was sitting at a little over 50% cash already. So it already had the cash inside. So when it fell less because, as I said right up front, the one place that you were really going to find safety was good old-fashioned cash. And then core shares, PREFTX. So we've touched on this one a bit, and I wanted to come back to it. Also a 31 March minimum disclosure document. Remember what preference shares are. They are debt instruments listed by companies. They happen to be listed companies in this particular case, and they pay dividends. And those dividends, the rate of the dividend is a percentage of prime. Now, the problem is they're showing us a great historic yield of 12.7%, but these are dividends that would have been paid in the first quarter, and we've seen massive interest rate cuts since then. Those 1% interest rate cuts not reflecting in what we're seeing here because of the dates that they pay. So your first issue here is understand that the yield going forward is going to be a lot lower. And if you contact core shares, they can give you details on it. The second part of the equation is what is the risk of perhaps some of these preference shares skipping their dividend. Now, some are cumulative. In other words, if they skip a dividend, at some point they've got to come back and ultimately pay that dividend. But most are not. Most are non-cumulative, which means they skip a dividend, that's it, it's skipped. Now, if you skip a dividend for a preference shareholder, you cannot pay a dividend to a normal equity shareholder. The question is how is it going to work? So the banks already, we've seen the SARB Prudential Authority request banks to not pay dividends on their equity shares. Will they therefore not pay dividends on their preference shares? Truthfully, we don't know. I think they probably still will. I think they will pay. Their dividend preferences are not massively in terms of onerous, in terms of cash, compared to an equity dividend. I also note that Invicta published a SENS announcement just today where they announced that they in fact are going to be paying the preference shareholder. So they declared today that they are. So Invicta is struggling, but they're still going to pay their dividend. So maybe the dividends are fairly safe, notwithstanding the rates will be going down. CPI, let's see if we can see if Capitec, in fact, I'm going to cheat. Let me just go into here. Let's see if the Capitec, because Capitec issued results. They passed on their equity dividend, but did they pass on their preference share dividend? Let's see if we got that paid out. Yep, so Capitec passed on an equity dividend. You'll see no dividend for 2020 on equity, but on preference shares, Capitec did pay. So seemingly what we're seeing is that the banks are saying, you know what, we're going to pay the preference dividend, so you're still going to get them. So then your risk, I suppose, is that if these companies go into bankruptcy, you know, like, and I look at them, and I mean, I don't think any of these are you know, bankruptcy candidates, but we live in interesting times. Mike, what's the allocation between offshore and local and APSA volatility managed ETF for all three funds? It is local. So it is, and if we go back to it here, they are JSE listed, but if we run our eye down those stocks, British American Tobacco, Anheuser-Busch, Richemont, BHP, I mean, these are all offshore. They're local companies, but they're earning money offshore. Naspers is Tencent. Anglo American and BHP are earning in dollars. Tiger Brands, Vodacom, mostly local, although Vodacom's got Safaricom and other bits and pieces. So they're local equity, but that equity obviously has rand or dollar exposure in fairly large chunks. And so certainly British American Tobacco, Anheuser-Busch, and Richemont are global companies rather than South African companies. So the pref shares, your yield is going to be a lot lower. Can we crunch it? So probably, let's go see what the yield is sitting at the moment. We can kind of hack it to a degree. So PREFTX is the code. Yield down there is 8.1. That is after dividend tax. Remember, this pays a dividend. The attraction, particularly of the PREFTX, is that you pay income tax on interest received. Depending on your age, your first 24,800 or 34,500, 34,500 is you don't pay tax on the interest received, and thereafter added to your income. If you are in a high tax bracket, you could conceivably be paying north of 20%. If you're in a low tax bracket, then perhaps something such as that the retail bonds are better. Of course, you know, less liquidity there. But anyway, so we're sitting at 8%. That is after your 20% DWT. Rates have come from 10 to 7, so slice another 20% or 25. You might only be sitting on a yield of closer to 6% after tax. 6% after tax, not shabby. I mean, not shabby at all. You also have a risk of capital loss in this environment, which typically you wouldn't have. So you can see that graph there. In fact, let me pull it up here. I get PREFTX. So it fell 3 rand. It fell a third. I mean, from February into, well, from late March into early April, it lost a third of its value. It's recovered. It's about almost halfway back from its 920 down to its 640, recovering back. But you also have got capital risk, or as the case might be, you might get yourself capital appreciation as well. The last one I pulled, and I come to this one quite often. This is an offshore ETF. It is a pure equity ETF. But what it does by its logic is it says we use dividends. We're not hunting high dividends. We use dividends as a process of determining quality. So, for example, for an American stock to be included, and let's go down to the regional weightings, for an American stock to be included, they have to have a 25-year track record of paying dividends. That is monster, which means no Apple, because 25 years ago they were bankrupt. No Facebook, no Amazon, because 25 years ago, I mean, Amazon existed but wasn't paying dividends. Facebook and Alphabet didn't exist 25 years ago. So what you end up with And if you look at the breakdown in terms of sectors, your biggest holding is industrials and then consumer staples. Now, consumer staples are typically very defensive. That's things such as, toothpaste, shampoo, those sort of things. Times are tough, but you're still brushing your teeth, probably still washing your hair. Financials then come up next. So what we see in terms of the company holdings, Clorox, Walmart, Hormel Foods, Colgate-Palmolive, etc., these are not your typical stocks that you would expect to see in a offshore or a global portfolio. They are typically more defensive. That said, I go back to the point I made earlier, GLODIV, is that when the markets collapsed, this went down as well, maybe a little bit less, lost around 25%. Global equity markets were under pressure, but to a larger extent, although obviously currency has softened the blow to a degree, but it recovered quite quickly. That sell-off was, I mentioned earlier, when the crisis hits and markets are collapsing, everything goes to one correlation and everything heads south. But it came back quick, and in fact, we can see just here new highs. Now, new highs quicker than even the Nasdaq and the S&P hasn't yet, or new highs for the year. The driver would have in large part been the ZAR, of course. And if we just go look at a quick, just for comparison's sake, a Signia, the S&P 500, that was the ZAR. The S&P hasn't yet made new highs for 2020, but the ZAR helped. So this GLODIV is what they've done. I want to go there. What GLODIV does, they take your rands, they convert it into dollars, and then they go and buy the shares. So you've got two drivers of price here. That first driver of price is the equity that sits underneath it, but the second is currency. What I like with this is that typically when markets are collapsing, our currency is going to collapse as well. Why? Simple reason. People are selling South African equity and bonds, and they're taking their money home because they're scared. So we see the currency collapse at the same time. We've subsequently seen a rand strengthening. It's weakened over the last 2 days. It was 1650 overnight on Wednesday, 1720 this morning when I last checked, although I think it moved to 1712 a little while ago. But it kind of gives you that protection in a sense. So it should, under normal circumstances, be less volatile. It should fall less. And when things go crazy, it will fall. But that weak currency will help it markedly. People asking about the local one. I didn't pull the local one up. Let me go and find it. I can't remember its code. Exchange Traded Funds. What is it? Gelprop. Oh, it's just GLODIV. Okay. No, GLODIV is the offshore one. No, I just can't. No, let's cheat. Let's just go to the core shares. Coreshares.co.za. I didn't bring it in as a safety one because in South Africa, although they're focusing on they're doing the same methodology, although their requirement is only 3 years of dividend. So we find ourselves with a lot less in terms of sort of defensive. And truthfully, South Africa doesn't have that many defensives at all. Equity income, multi-asset. I'm not even seeing it here. I think I'm going blind. Top 50, S&P 500, global property. Yeah, nope, that's not what we're looking for. Smart beta, nope, it's not property. It's not a fixed income. The div tracks, someone does, oh, there it is there. So there is the div tracks. The div tracks is, let's quickly grab that fact sheet for the div tracks. Helena, you were asking about the div tracks. Excuse me. What we got here is it's a decent yield. I mean, 4.7. We'll go have a look at it in a moment. But broadly, it's equity, and they've got some filters, and certainly we see some dividend coming through, but it's not a giant dividend. It's not absolutely massive, and in that sense, it's a case of, well, is it really going to do it? I mean, the general equity, it was doing nicely, and then it fell down a bit. Let's grab its proper div TRX. Its yield has gone to 3.7 after your dividend tax. Not bad, not knocking it out the park. That's the global dividend aristocrats. I don't want the global div tracks. Why didn't I include property? Good question. I didn't include property because I think at the moment we're going to see some significant pressure for property in terms of their dividends. So the question is, are they going to be able to pay dividends? We're seeing a bunch skip them for the first half of the year. What's going to happen in the second half? Honestly, don't know. We've seen updates, Hyprop and Liberty 2 degrees, as well as Growth Point, all broadly coming to the same story. They're operating at around 2/3 or 3/4 of gross lettable area is open again. And truthfully, it depends how many restaurants they have. More restaurants means less opening. Growth Point being hurt by V&A, which is a lot of restaurants, but also a lot of tourists. Foot traffic is back at about 60 to 70, 75%. But you know their rental collections also sitting at around 70 or 80%. Those dividends are definitely under threat, and that's a concern. I mean, that absolutely is a concern. I see dividend aristocrats. I see div tracks, which is their local. Yeah, those are the two there. So the div tracks is the local one. It's not a bad yield, 3.7. Let's quickly go over peek at Satrix div. That's actually a 4.9. That is a significantly chunkier one than we've typically seen from the Satrix div. Understand how the Satrix div works. It uses historic dividend yields and then says what's the forward dividend yield going to be, and it then takes the highest forward dividend yields. And the problem with the forward dividend yield is, particularly in the current environment, is what's going to happen to those dividend yields going forward, and there certainly could be a lot of pressure coming under those dividend yields. And that div tracks at times has. Sorry, Mark, Kenneth, I see you both well ahead of me there, and I wasn't paying attention in the Q&A box. The forward dividend yields are, you know, they're under pressure. Michael, resources. Trick with resources. I mean, and looking here, I mean, you could do something such as gold for security, and you could do something such as GLD. There's the gold ETFs as well from One Invest. The trick with them, they're going to offer you security, but what they're not going to offer you, and we can debate whether you want it or not, they're not going to offer you any sort of distribution. Why did GLD not come up? Because I spelt it wrong. Let's go actually look at GLD here instead. So yeah, I mean, gold certainly has. I mean, it's come under a bit of pressure, and truthfully, I think a lot of that pressure is more due to rand strength more than anything else. When markets were collapsing initially here, gold rallied, and then it came down, and then it's rallied massively again, helped in a large part. So, Marco, you could put some gold or some gold ETFs in there as a sort of hedge in terms of security. Rob, tax implications for Tracy, i.e. on interest and capital gains. That's a great question. When I spoke to an accountant, and it was a number of years ago, his view was that if you're holding 3 years, you would pay CGT. It doesn't pay dividends, so there's no dividend issue. So essentially, you would be paying your CGT on it because it's a listed instrument. Question right up front, continuing because they only register up to today's. Yes, they are. Oh, I know what. Yeah. So what happens is they eventually expire. Danae will then send out reminders and they're like, yes, we are continuing with Fund Fridays, and we're going to be changing them up a little bit, but we're going to be continuing with the logic behind the Fund Fridays. They will be continuing. I'm going to see if I can quickly, while I'm here on the back office, I'll add to end of June, and then in July we're going to change them slightly, but broadly we'll still be talking ETFs and the like. So to Mike's point, and some other folks are saying, what about commodities? You could add commodities in. I mean, they really are, in a sense, a hedge rather than a low volatile. And of course, they've got zero yield for them. The local dividend aristocrats got a decent yield, but you're going to get the volatility coming through. The Satrix Divi Plus that yield at times is absolutely phenomenal. Now 4.7 post-tax is not a bad yield, but their methodology means that at times that yield will really disappear. For example, when African Bank and PPC, who had both been very generous dividend payers, when they cut their dividends, they were both in the PREFTX ETF, and therefore took quite significant pain in holding them. It's almost in some senses, it's a contrarian ETF. And what I mean by that is that your dividend yields spike for one of two reasons. One, because you're paying increasing dividends, or because prices have fallen. So often it gives you the fallen, once were stars. Now that's fine if they recover. It's not so great if they're African Bank and end up in bankruptcy. Kumba Iron Ore, which was a giant dividend payer, they held that when it ultimately stopped paying dividends. It came back, but by then it had been excluded. Ladies and gents, not seeing any further questions, and we've hit our time, so we'll park it there. As I said, we're going to be doing some slight changes to the Fund Fridays, but it's still going to be going as per usual. All the videos do get to our YouTube page, my absolute pleasure. Just go to YouTube, search Standard Online Share Trading. You'll find all of them. We take the Monday morning one with myself and Danae, the Wednesday website one, and then the Fund Fridays, and we drop all of those onto the YouTube page at the same time. Mark, pleasure. Two Marks, one with the K, one with the C. Gents, absolute pleasure. Simon Carr, always a pleasure. Ladies and gents, you have I don't know where you are in the world or the country, it is a cold, cold Josie. My advice is if you haven't left home, don't. Stay at home, stay safe, wash your hands. Johan, absolute pleasure. Craig, always. Cheers, folks.